Welcome back to the channel. Today we're going to talk about retirement and when maybe you possibly need to move yourself to a financial advisor. And with us today is David. David, go ahead and introduce yourself.
Brad, great to be here. Great to be on the channel again. I know you have such a great group of followers on the YouTube and also in your private groups as well. So honored to be here. David Nicholas, owner and CEO of Nicholas Wealth Management. I've been a financial advisor for, hard to believe, but this is 20 years for me. I'm ready to retire, Brad, but no. So at Nicholas Wealth Management, we're a fiduciary investment advisory firm, but we specialize in retirement planning. I've spent my entire career on retirement, and so there's so many different things that impact us as retirees than when we're in our 20s and our 30s and we're growing our money. And so there's so many other factors that we've seen really derail retirements that we've just tried to help our clients avoid. So, Brad, happy to talk to that. Also, we have a investment management wing of the firm, which we have 3 publicly traded ETFs that we've talked to you about as well. So glad to be here and happy to talk to this really important topic of retirement.
So, a lot of people get to a certain age and their health starts to decline and everything else, mental capabilities. So, when we look at financial advisors, when should or possibly our wives don't want to take the financial section over, when should we start these conversations with a financial advisor?
Yeah, so it's going to be different for, I would say, I see a wide range, right? We have some clients, like for example, I just came out at a meeting right before this with a client that they are 5 years away from retirement and they've already hired us. Uh, so they're young, they're late 50s and they want to retire at age 62, which I would say is a great age. It would be on the younger side for retirement, but we're seeing that age get younger and younger. And so it just depends. So you've got people like clients like that who are pre-retirement. You also have individuals that, David, I'm already retired, or I've been retired for a few years and I've been managing on my own. And there's a lot of the feedback I get is sometimes it's the spouse saying, David, I like my husband or my wife a lot more when they weren't managing their investments all day. And so some of it is just like, what do you enjoy doing? Do you want your retirement kind of revolved around the day-to-day management of your investment funds? And the other end is on the flip side, to where we've just gotten to a point where whether it's capacity or there's health factors that don't allow us to manage an account, that will work with an advisor. But Brad, one thing I want to talk through is just the difference of can and should, right? I would say that the majority of our clients were very smart people. Brad, they're like yourself. They worked hard. Many of them may have graduate degrees. The stock market isn't foreign to them. So I always say I put them into two camps, can and should. And if you're watching this, you may say, David, I have the ability to manage my own investments. A lot of times we equate ability with, yeah, if I can do it, I should do it. And I always say, well, just because you can do it, you really need to ask yourself the question, should you do it? That's a question we can unpack a lot, but that should question is really around, yeah, what do I want my retirement to be? If something were to happen to me, is my spouse able to come in and confidently pick up what I've been doing? I've had many individuals tell me, David, I know the markets. I've self invested for 20, 30 years. But the reason I want to work with you is not because I can't do it, but I really think about my wife. And if something were to happen to me, I don't want her to be in a position where she's one having to take over the day-to-day management, but I know she's not going to want to do that, nor can she. But I don't want her to have really rely on this decision of who can she actually trust as a financial advisor. I want to go ahead and establish that relationship now. And so again, everyone's a little different, Brad, but we see really the difference of can and should. And it's individuals coming to the reality of, really, I don't know if I should be doing this. I can, but maybe I should talk to a financial advisor. It's just making that transition. That's really unique, and it can be different for each person.
If you had a short list of questions to ask during the interview process of a financial advisor, what would be some of those key questions that you should be asking the person that you're getting into a relationship with?
Yeah, the first one's probably a simple one, but it's the F word. It's the are you a fiduciary? I can't overstate that. Based on the new laws, technically every advisor is supposed to be a fiduciary, but there's also certain things that can really separate that advisor to say, hey, have they really gone the extra mile to ensure that they are a fiduciary? One of the biggest things is a CFP. Almost all the advisors at our firm, we just hired a new advisor that doesn't have a CFP. But for example, all the financial advisors at our firm are CFPs, means they're certified financial planners. To be a CFP, it's pretty rigorous. You have to have a college degree. You have to have 3 years working experience. You have to meet all the education requirements of the CFP, and then you have to take the exam, and then you have to keep your annual compliance and CE done everywhere to keep your designation. You don't have to just work with a CFP, but whenever I see that an advisor has a CFP, it tells me that they went in and put in the extra work. I like to see a graduate degree. One of the things that we look at. Did you go on and do extra schooling to give you a leg up when it comes to financial planning? So that's the first area. Are you a fiduciary? Number two would just be, how are you compensated? Because there's a lot of financial advisors that call themselves financial advisors, Brad, but they really just want to sell you a product, whether that's insurance, whether that's an annuity. Not that there's anything bad with those, but you just want to know, what am I getting? Am I getting a commissioned, really salesperson, or am I getting a fiduciary advisor? And how you know that is, number three, do you build financial plans? And so I think going into retirement without a financial plan is like building a house without architectural plans. So one of the things that you want to look at is, number one, do you build financial plans? Do you charge for those plans? What is, how does that work exactly? But you want them to be a fiduciary. You want them to see that they went the extra mile for designations or school. And you want to make sure that they're not just a salesperson, that they actually build financial plans. So those are the couple of things that we look at. And also, what are some of the other services, right? Estate planning, tax planning, healthcare planning. Does a firm offer those things? And if so, that to me can tell me that they are looking at a broad, holistic approach to financial planning.
One thing that you didn't touch on was legacy planning and estate planning. What are the key factors that you should have in a estate plan or a legacy plan?
Yeah, so we spend so much time talking about our investments, retirement, that I would say we sometimes spend very little time talking about our legacy. And so we have a crest at Nicholas Wealth Management, and we have a tree as part of our crest. And there's this great saying, Brad, you may have heard it. It says, societies grow great because wise men and women plant trees in whose shade they may never sit. I know there's a lot to unpack there, but basically what it's saying is, like, if I put seeds in the ground today and it grows a tree, it could take 20, 30 years for that tree to grow to a point where I may never experience the fruit of that tree or the shade of that tree, but I'm doing things today to impact those that come after me. Legacy can be different for everyone, right? It could be how you're remembered. Maybe you have kids or grandkids that you want to make sure that they're okay and have a good life. And so I always say, your legacy, you should always have conversations around, if you're not going to spend all of your money in your lifetime, how do you want your money to be spent after you? So that's the big picture. But if we get down more granular, so in a estate plan, you got to have a few things inside your estate plan. You've got to have at a minimum, you have to have a will. But as a reminder, a will is the document that gets your assets through probate, right? The judge gets the will and he says, okay, this is what the will says. But here's what we want. We want as little assets going through probate as possible. And what I mean by that is, if you have an investment account, a brokerage account, a retirement account, or a bank account, all of those should have beneficiaries attached to them. If you have a beneficiary, that bypasses probate. So I tell my clients all the time, I want as little to go through the will as possible. The will is going to be for maybe your primary residence and your personal belongings. That's it. I don't want any investments or assets going through will. I want them going through a beneficiary or payable on death. Last couple of things are healthcare directives. So you got to have a will. You have to have your healthcare directives, sometimes otherwise referred to as a living will. God forbid, if you're incapacitated, what medical decisions should be done. These are all things that you and your spouse want to talk about if you're married beforehand. Also, power of attorneys. So there's two types called springing and durable. I like the power of attorneys that come into play if we're incapacitated. So that's generally called durable power of attorney. I don't like giving kids, I don't mind giving my spouse power of attorney, but I definitely don't want my kids or other people to have a power of attorney that has power while I'm alive and while I have cognitive decision-making ability. I only want the power of attorney to be active if me or my wife cannot make decisions for herself. So really, you get your living will, you get your healthcare directive, you've got your power of attorneys, and then you also potentially have a trust. Most people don't need a trust, but if you want to control your assets in some way after your death, a trust can make sense. But you can pass on think the number now, the new tax laws were just changed, but it's well over $20 million that you can pass on without estate taxes. So you almost will never need a trust for estate tax purposes today. It's mainly if you just want to pass on, or sorry, if you want to control your money once you're gone.
Talk to us about long-term health care, because most people don't even put that into any type of plan. How can that really harm you if you're not planning for it?
Yeah, I'll tell you, the costs for long-term healthcare are pretty significant. Genworth does a really good study. It's called the Cost of Care Study. You can just Google it. And what it does is it shows you what costs are today and where they will be 20 years from now. So like Brad, you're young, no risk of healthcare or long-term care today. But if you look into the future, right, 20 years from now, 20 plus years from now, what is the cost of healthcare going to look like? The average, let's just take Atlanta, the average assisted living cost, and you may have had family members or loved ones that have to deal with this, it's around $6,000 per month in today's dollars. You fast forward 20 years from now, that number could be $17,000 per month in assisted living care. The average stay in a long term care facility is 3.5 years. So, roughly $200,000 a year for almost 4 years could be upwards of $800,000 per person for long term care. You may say, David, that's insane. Healthcare has risen at close to twice the cost of inflation over the last 20 years. We don't see it slowing anytime soon. So, all right, David, I get that healthcare is expensive. Well, how do you pay for it? So, I'm a big believer, Brad, in having your primary residence paid off before you retire or within 5 years of retirement. Well, David, I have a 2.7% interest rate. I'm not going to pay off my house. Fair point. But I also like the peace of mind decision versus a rate of return decision. When I get to retirement, I lean more towards peace of mind, meaning I just want to be out of debt if we can. We advise our clients that. Let's just say, Brad, you have a home today. I don't know. Let's just start. That's worth $400,000 to $500,000 today. Let's just say as an example. Well, if you just index that for inflation, that home will be worth $800,000 to $900,000 20 years from now. Okay. So if your primary residence is paid off, I can't live in my home and be in a long-term care facility at the same time. So what generally happens is we sell our home. Now I have $800,000 that I can put towards long-term care. So that's the first thing. We call that being self-insured. The equity in your home can really be used for long-term care down the road. But second, we can subsidize that with a type of long-term care policy. I'm sorry for the long-winded answer here, but there's a couple of different ways that we can do that. The first one is through just traditional long-term care, which, Brad, I am not a fan of. We can dive into this some more. But traditional long-term care is kind of like car insurance. You pay for it, you pay for it, you pay for it, you never want an accident. But if I pay into my car insurance for 20 years and I never have a car accident, does the insurance company give me back all my premiums? No. So I always say long-term care insurance is the worst type of insurance because you pay into it, you hope you never use it, and the insurance company can change the amount that you pay every year. It can be pretty much a disaster. So there's traditional. The third one that we like is called a hybrid policy. And so we can actually dive into how this works. But why I like the hybrid policies is you put in a set amount, the insurance company can't change it. And oh, by the way, if I never need long term care, I've yet to meet someone, Brad, that says, I hope I go into a long term care facility. The goal is that you never need it. And if you don't need it, all the premiums that you paid into the policy go to your kids or your grandkids or your spouse as a tax free death benefit. So to me, the hybrid way, and I can show you an illustration of it and how it works. But to me, if we're gonna give us a little additional coverage, I like the hybrid insurance policy, Brad.
Should a financial advisor have all these in a checklist and go over these with their clients maybe on a yearly basis? Or is this just something that you see the guy once and you're done?
Yeah, no. So at a minimum, the advisor should be meeting with you once a year. And so that should be part of whatever you're paying in management fees. That should cover, you should not pay any additional fee for advisor meetings. Some advisory firms do charge you a planning fee to put a plan together. That could range from $1,000 on the low end to $5,000 on the high end. We don't charge a planning fee. Not that that's good or bad. It's just we don't. But a lot of firms may charge you a planning fee, which is fine. Just know what you're getting for it. But no, you should be able to meet with your advisor at a minimum once a year. You may want to meet more than that if you have more questions or concerns. But you should be reviewing your financial plan every year. The cash flow plan you should be reviewing every year, meaning how long will my money actually last? healthcare plan as well, and also your investments as well. So all that should be done every year, Brad.
David, if somebody wants to get a hold of you or your firm, how would they do that?
Yeah, no, I appreciate it, Brad. But so we've got a website, nicholaswealth.com, that you can go to. And there's a lot of great resources on our website. So if you go to nicholaswealth.com, you can read. I mean, we've got so many resources. We have these guides that are actually really good. So if you go to resources and you go to guides, I'm just pulling those up here. We have a tax guide. We actually have a healthcare guide that we just finished writing that's coming out. We have a income guide that's coming out. These should be up in the next couple of weeks that I would encourage you to go look at. There's also just a contact us button somewhere on our website. We should probably make it easier to find. That you
I think that's called schedule a meeting.
Is that oh, here it is. right in front of me. That's right. So you can schedule a meeting, and there's a Zoom meeting right here. So you can always call us, which is the number down below. But a lot of people have been doing Zoom meetings with us, which we love doing as well.
Finishing up this conversation, is there anything else you'd like to bring up about financial planning and long-term planning in retirement?
So I think I just had a meeting with our team this morning about what I call a retirement mindset shift, Brad. And look, me and you are similar in that we want to get a high return, right? If I put money to work in investment, I want to get a good rate of return on that. But I will say, when we come to retirement, there's this thing called standard deviation, which I won't bore us all with, but standard deviation is just how volatile your portfolio is. There's something else called sequence of return risk, which means the sequence of my returns can impact how my portfolio lasts. And so one of the things I would tell us to think about is I am actually okay getting a lower rate of return in retirement if that means the standard deviation of my portfolio comes down. Okay. If I look at two portfolios, one is a 9% rate of return, but it has an 18% standard deviation, or a 6% portfolio that has a 6% or a 5% standard deviation, the lower returning portfolio will normally last longer than the higher returning portfolio. The difference is if I'm making withdrawals. And so this is why if we're making withdrawals off of a portfolio, we want to reduce the standard deviation. I want to reduce the volatility because I can actually get a lower rate of return if the volatility of my portfolio is lower, because it means when I'm taking withdrawals off my portfolio, the worst thing I could, if you just remember one thing from this call, Brad, the worst thing I could ever do in retirement, I know you know this, is to take money off of a portfolio that's losing money. I never want to sell an asset at a loss to cover my income. So worse, we call that reverse cost averaging. You can't ever recover that money because it's not invested. So Brad, you've done a great job of segmenting the portfolio with income, drawing less of the income out than you're actually earning. But we never want to sell capital to cover our income if we're selling at a loss, and we want to reduce and mitigate the volatility in the portfolio. We could spend a whole hour on that, Brad. I love talking about standard deviation, but it's a big concept just for our viewers to understand is lower the volatility, and I can actually increase the value of my portfolio over time by actually taking less risk. And even I'm okay with a lower return.
Thank you for those comments, David. Fully agree with them.